afternoon, everyone. Thanks for joining us. And we've got some great interest here, a few hundred people that have logged on. And obviously, we know it's a hot topic today with our clients at Peakhill. And Harley Gold, I run Peakhill, our company. And we're very active on the CMHC insured lending side and conventional lending side in the multifamily space. And we'll look to do over $2 billion of financing this year on construction loans across Canada, small markets, large markets everywhere. And we'll do probably 70 to 100 projects throughout Canada this year is what we're looking to do. And so I'm here today with two great guys from Platform that have worked with clients of ours on the insurance side and bonding. So I'll let them introduce themselves and they'll introduce Platform. So we have Frankie and we have Brandon.
Frankie, good to meet you guys. I've been doing this for about 8 years now, focusing on developers. Came from the underwriting side, managing a team of underwriters at a big insurer, and now I'm over at Platform on the broker side.
Mm-hmm. And then Brendan Farrow, nice to see everybody. Again, similar to Frankie, been doing this for about 5 years on the bonding side, and previously the construction insurance was my focus.
So let's jump right in. So bonding and insurance for development 101. Brief table of contents. Brendan's going to briefly talk about who Platform is. Mm-hmm. We're going to jump into CMHC's new bonding requirements. We're going to talk about development bonds. So those are essentially LC replacements for your municipal obligations. We're going to touch on construction lien bonds, and then lastly, we'll end with bonding and insurance for condominiums.
Yeah, so Platform, we're a boutique risk advisory firm practicing nationally across Canada. We have offices now in Vancouver, Calgary, Edmonton, Kitchener-Waterloo, Toronto, Ottawa, and Montreal. And construction is really the focus of our group. We have 150 employees who focus on everything construction, real estate, and the built form space. So from general contractors, trades, large asset managers who have income producing properties, to the developer side of things, where Frankie and I focus on. Now that's we have segmented the construction insurance side and then everything bonding and surety, and that's what we're going to speak to today. Yeah, so this was more, I just wanted to set the stage on our practice group. So we really do everything soup to nuts in the life cycle of a residential development. So from when you acquire a site to close it out and then into your operations that just keep occurring, we can help from every aspect. We're going to play in or speak to the green space today. So that's everything from the development bonds, your Terrium bonds, again, CMHC, which is top of mind, and then some lien bond stuff as well.
Okay, as we go through the presentation, if you do have questions, you can put them in the chat. We'll take a note of them and we'll ask the questions as we go through or at the end. And there isn't an order of questions here. We're going to make it a bit of a discussion and try to get through some questions that we know our clients, developers, and construction managers have been asking us as they work through the process. Some people are new to bonding, and some clients have utilized it in the past before. So why don't we go to the CMHC bonding requirements?
Yeah.
I will generally say over the last few years, it's been up to the lender to decide whether a project should be bonded or not. And as a lender active in the space, there are projects where we find from a risk perspective, whether it's loan to value being one risk element, given the size of the project, given the experience, given the liquidity, the net worth, we may have asked for bonding and require bonding, or we may have looked at construction managers that are bondable, meaning that they have the ability to be bonded, and we may have waived that bonding requirement. And as we know, CMHC now is looking to require bonding on almost every project. So.
Yeah, seemingly. I mean, we'll jump into the next slide. So like you spoke about, previously up until that November 2024 change, CMHC was waiving bonding seemingly, and what we've heard across the board, 9 out of 10 borrowers weren't required to post bonds to the lender via CMHC's requirement. As of November 2024, CMHC, like Harley alluded to, is implementing this across the board. We're hearing 9 out of 10 of projects that CMHC is insuring under the MLI Select program are required to post bonds. Now, there are alternatives. There's you can reduce your loan by 10% of hard cost or post a letter of credit at 10% of hard cost. We still think that bonding is the most cost-effective solution to the three. And we're going to jump into kind of what these look like, some of the challenges you may face from an underwriting perspective, and our approach to getting these over the line. So right out the gate, this is the two general wordings that you're going to see from CMHC. The option A and option B. Option A is it reads that the fixed price contract must be bonded at the level of a 50% labor and material bond and a 50% performance bond, with the approved lender appropriately designated as the beneficiary of the bond. Really what that is on option A is primarily we're seeing that from developers who are self-performing and acting as construction manager, or one and the same for all intents and purposes. And for budgeting purposes and for the sake of this discussion, you're looking at about 100% of your hard cost plus CM fee on a CCDC 5B, or 100% of hard costs on your STIP sum if you're going forward with the CCDC 2. That's option A. Option B is the alternative that we see. This is typically if you're using a third-party general contractor or construction manager. CMHC has written that they want all major contracts. For the sake of this discussion, and from what we've seen kind of boots on the ground, that's more your critical path trades, or about 2/3 of hard costs from a budgeting perspective. And the nuance to this is also that they're asking for the approved lender appropriately designated as the beneficiary. What that means on the bonding side and on the surety side of things is that the lender or the bank is listed as a dual obligee as well on these bonds, so that they can call on these and it provides them financial assurance that the project will be complete.
Okay, so how do these CMHC required bonds function? So Brendan alluded to the requirement for both a performance bond as well as a labor and material payment bond. So a performance bond essentially provides protection to the owner, and also in this case the lender, if the contractor defaults. So they're typically issued for 50% of the contract amount, and they're triggered when the contractor fails to fulfill their contractual obligation. So essentially, if the contractor for whatever reason cannot complete the work, or perhaps they go insolvent, the performance bond can be called on and they will rectify the issue. So in order for the obligee or the owner to make a claim under the bond, they also have to have met their obligations under the contract and bond terms. Labor and material payment bonds, they guarantee that all claimants, so that those are the subcontractors, the suppliers, and others providing labor and materials, will be paid for the work on their project. So a claimant under a CCDC standard form contract is any party with a direct contract with the contractor. So what these bonds essentially guarantee is that the subs of the contractor will be paid for the work.
Mm-hmm.
Okay, so you got to pay for bonding. CMHC requires it. What are the benefits of bonding to you? So for developers, we've kind of outlined 4 major benefits of bonding that we think are important to understand. So number 1 is risk transfer. So if your general contractor defaults, the insurance company will step in to complete the project or compensate for losses. So the owner essentially shifts performance risk back to the insurance company, who's the bond issuer. There's also a project completion guarantee. So the bond guarantees project completion if the general contractor fails. So that reduces potential delays and financial risk. Essentially, the asset at the end of the day is going to be completed if there is a bond in place.
Is that the entire, because it's 50% on the hard and 50% on the labor, is that only 50% that's insurable, or is it just the entire project?
It's 50% of the hard cost for
Okay.
performance. Usually, in most cases, that's enough to actually rectify the issue, right? We'll talk about it more and how a claim progresses in the slides, but typically that's enough. Usually, a project doesn't fail when it's not out of the ground at least 25-30%. So subcontractor and supplier protection is another benefit. Labor and material payment bonds, like we discussed in the last slide, ensure that subs and suppliers are paid. So that prevents any possible disputes and liens being put on the project. So if a lien gets put on your project, the lender can no longer fund until it's rectified. So this is also really important. And then lastly, financial vetting and pre-qualification. So this is big if you're using a third-party general contractor. So a surety, or the insurance company, is going to conduct a strict financial and operational review of the general contractor before they actually issue bonds. So they essentially want to make sure that the contractor is bondable and that they're qualified to complete the works. So you have the benefit of having a insurance company who does this for a living, is looking at hundreds of contractors on a yearly basis. Look at them and say, hey, you know what? These guys can actually complete the project. They have the liquidity to do it. They have the wherewithal to do it. And they've vetted them and they've given them the bonds. So you have that in the back of your head that they will actually complete the project.
How long does it take the insurance company to give you that answer on the general general contractor or CM?
It can take, from a
Yeah.
pre-qualification, typically what they'll do, they'll go in their system and see if they've reviewed, they've looked at their jobs previously.
Okay.
If they have, they'll know it kind of instantly. If not, they'll want to collect that information,
Yeah.
and that could be 2 to 3 weeks potentially.
So when you like the third party general contractor usually has to get the bonding for themselves. So they will have a bonding facility in place with a surety company hopefully already. If they don't, then they can reach out to us, for example, and we can set one up for them.
Yeah, when the rubber hits the road, so how do these pay out? So these are underwritten not to pay out. That's what the surety is underwriting, unlike a true property casualty policy. But if it does, initially there's an investigation. So the surety is going to request information from both the contractor and the obligee and collect as much as they can. Then they're going to review if they are in default of the contract. These bonds are contractual default instruments. So if there is a default in the contract, it is a valid claim. If it's not, it will be denied. If it is a valid claim, the surety can step in to work through the negotiations with the current general contractor or construction manager who's on site. If they don't see a path forward, what they'll do is they'll hire a new construction manager, and at the very worst case scenario, they'll pay out the obligee up to the penal sum of the bond's value. Again, they're taking guarantor security here. And so what they will do is if they do pay out a claim or there's an additional cost to get a new construction manager, they will subrogate and go after, firstly, the corporate guarantors to make themselves whole, and secondly, the personal guarantors.
Yeah, so the surety has the three options that they can do in the event of a default. Usually they try to pay out as little money as they can.
Mm-hmm.
So for example, if the general contractor has liquidity issues, they could just come in and, hey, give them a $500K and say, hey, this is going to help you across the finish line to finish the project. Rarely do they actually pay out the full penal sum of the bond. It's in their best interest to get the project complete instead. So if they don't think the general contractor can complete the work, they can go hire a new construction manager. And because they offer bonding for so many other general contractors, they usually have a Rolodex of people they can call in to come and complete a job.
So the challenges that we've ran into. We're seeing a lot of developers who are self-performing, and that's where we're being running into challenges, because traditionally contract surety underwriters are looking to leverage a working capital figure to get to an approved facility size. So they'll look at liquidity, your working capital, and they look to a 20 to 30x leveraging of that to get to an approved facility. So an example, on a $30 million project where you're posting two $15 million bonds, they're looking for about $1 million in liquidity to approve that bonding facility. Now, what we've done and where we've had success is working to find creative alternative security structures to get these over the line. And that's a makeup of potentially a letter of credit posted to the surety. That can be mortgage security. Typically what they'd like is a first collateral charge on an unencumbered property. And then there's also the option to beefing up the guarantor package. And that can be pledging special purpose vehicles that own income producing assets to the guarantor structure to beefing it up and get this over the line.
So that tends to happen more frequently on self-performing, because those are developers that are in the real estate business may not have as much liquidity.
100%.
As a regular GC would already have that because they're required to all the time.
Yeah, and they're not topping up their bank account and leaving cash sitting there like a true general contractor would.
Yeah. Developers finish a project and the revenue usually leaves to the investors. So. Okay, so what kind of underwriting information do we need to get you these bonds? So development specific criteria. So this is all stuff that your lender will already most likely have. So we'll ask for the project budget and pro forma to understand the feasibility and revenue of the project, the schedule to understand the timeline and milestones, a list of your critical path subtrades if you know them, a copy of the financing agreement, the CMHC certificate, and then we'll also want to understand the developer's experience. So can they complete this project as outlined? Have they done some in the past that are of similar size and scope? It's all things that we'll want to evaluate. And then we'll also want to understand who the contractor is. So, and what kind of information is backstopping that contract. So we'll ask for a copy of the CCDC contract to understand the terms and conditions as well as the obligations. A copy of the work on hand for the contractor. So we want to understand their current work commitments and backlog to evaluate their capacity to actually take on this new project. The accounts receivable and payable is also important to understand. So we want to understand their short-term liquidity and cash flow position. And then lastly, we'll ask for the financial statements for both the developer as well as the contract to understand their financial strength and liquidity. These bonds are guaranteed by the developer and then also the contractor in the event that they're in-house performing. So essentially what we want to understand is the development feasible? Can the developer complete the work? Is the contractor capable to complete the work? And how do their financial statements look and do they have the liquidity to support a project of the size and scope that they're contemplating?
Are you seeing challenges getting this information from developers at times? Some of this?
I would say no, because most of the time, like, they're going to provide you with the same information, especially on the developer specific criteria. Like, they'll have the financing agreement in place and the CMHC certificate. This stuff for the contractor, perhaps if it's a new entity, they might not have that, but we can work with them to kind of put that together if they've never provided it to an insurance.
We have work on hand templates that we've shared and helped collect that information.
Okay.
Yeah.
And once this is all received, you're going to the market to get a quote on this. How many insurance companies would are bidding on this stuff?
I'd say there's about 5 to 6 real players in this CMHC specific performance and labor material bonding space.
Yeah.
2 of them are kind of ahead of the pack, but we're growing it. So I mean, Frankie and I are going to insurers' offices seemingly on a weekly basis and trying to get more and more capacity given the increase in volume we're seeing for this requirement. Yeah.
There's a lot of insurance companies that can do this. They have the capacity to do it, but they might not understand how to do it. So we're essentially taking this presentation and making it more underwriting specific and going to them to teach them how we've been doing it to hopefully get them on board as additional markets.
Okay. And so to get a quote together for a borrower, is this like 3 weeks, 4 weeks, 5 weeks?
I'd say it's about a 4-week process, total negotiation. Like terms you may see within 2 weeks, and then you want to iterate and compare to what other competitive options you have. 4 weeks to get terms. We have power of attorney to issue bonds internally. So once, let's say, a signed commitment letter comes in, we can finalize the security within another week, call it 5 weeks now total, and then issue those bonds once the security is in place.
Yeah, and Brendan's going to talk about pricing in the next slide, I think. But like, they do cost, so we always recommend coming to us early in the game so we can at least get a preliminary idea of how much it's going to cost so they can bake into their budget.
Yeah. And like Frank alluded to, so there's typically a $5,000 to $10,000 underwriting fee, pretty standard across the industry. On the rate side, this is where there's some nuances. If you're using a third-party construction manager or general contractor who specifically has a bonding facility in place, we're not going to know what those rates are going to look like, and that's a discussion you'll want to start early with the CM that you are hiring. If it's a project-specific placement that we're working on, or you are a developer self-performing similarly, and we're placing this project by project, we're seeing 1.5 as kind of our benchmark rate applied to 100% of hard costs. We've seen it come in at 90 basis points. We've seen it as high as 3%, but 1.5 is typically our standard benchmark. And then just something to note, it is due within 30 to 60 days of bond issuance. It's paid up front, but it can be taken from the construction lender's first release. Like Frankie said, when we're engaged a little early and we have a sense of what the pricing is, we can send draft invoices out to the client specifically so that they can get it in front of their cost consultant and quantity surveyor to prepare that first draw, that this is included into that.
Is there much variance on the quotes from the 5 insurance companies in the space, or they're pretty similar?
There's some who don't have as aggressive security structures like the letter of credit requirements, but as a result, they charge more for rate. So you may see 2.5 from this market, but the security is more favorable, whereas another market may be 1.125, but they require a $500,000 letter of credit. So it's more of a structure than it is a rate competitiveness.
Okay.
Yeah.
And what about projects where, have you seen projects where it's not, you're not able to get it approved?
As of right now, we haven't, but given, again, the volume that we're going to be looking at and the varying experience and financial wherewithal of the groups that we're going to see, it may come up, and that's when we're going to have to, like Frankie said, we want to start these discussions early so that you're aware of, hey, we won't be able to get bonding. We're going to have to revisit our CMHC COI.
We haven't gotten no's, but the terms that are offered might not be favorable.
They may want other collateral
Yeah,
security or more liquidity.
Yeah.
things
For the
like
most
that.
part, like, we can write most things, but it might not be favorable, right? So in those events, maybe they go with the other option, like giving an LC or lowering their loan.
Yeah. Okay.
So moving on, away from CMHC and to development bonds. So most developers, whether you're building purpose-built rental, industrial, or a condo, need to provide some sort of security to the municipality to secure various obligations. So that's subdivision agreements, site plan agreements, maybe hydro and utility connections. And typically in the past, these were secured via letter of credit. So you either put money in a bank account and give a letter of credit to the municipality, or you have an LC facility baked into your conventional financing or your construction loan. The alternative is a development bond. So it's essentially a bond that acts the same way as a letter of credit, so it's on demand. Benefit of the development bond being that it frees up liquidity for developers. So these are off balance sheet security. They don't impact your bank borrowing capacity, and they're secured via an indemnity agreement only, so they don't tie up cash like a standard letter of credit. They're also cost effective. They're usually priced similarly to what a letter of credit would be, between 1% to 2%. We usually say we like to match or beat your LC rate. So then what's the catch? Why has nobody been using these in the past? Why aren't they extremely popular? And the reason for that is simple. Municipalities were slow to accept bonds in lieu of LCs. They didn't want to accept a bond in lieu of the letter of credit because they were happy with their letter of credit security. So over the years, many municipalities, with the help of surety companies like us, going in and pitching to them and showing them the benefits of the bond, have gotten on board with actually accepting these instruments. So City of Hamilton was big, Calgary, Pickering, Durham all accept these bonds. And then most recently, the biggest news is the change to the Planning Act in Ontario. So late last year, the province of Ontario made a sweeping change to the Planning Act, essentially saying that every municipality in Ontario now needs to accept these bonds. So now it's up to the various municipalities like Toronto, Mississauga to have their internal meetings to decide how they're going to move forward with this. Important to note, they're also widely accepted in other parts of Canada, Edmonton, Halifax, or Surrey, Kelowna, to name a few. There's a bunch that accept them now. We're keeping an up-to-date list of all the municipalities that accept them. So if this interests you and you want to free up some liquidity, even in the warranty phase, like if you have cash sitting around for an LC that should be returned in the next few years, we're happy to replace them. Let us know. We can check to see if they accept them. And we're also more than happy to go into the municipality on your behalf and kind of pitch the benefits of bonding and make municipalities realize that these act exactly like a letter of credit.
What's the security that the insurance company's getting on this?
It's usually indemnity agreement only.
Yeah.
Right? So that's what we try to do. But when you're dealing with like multi-million-dollar bonds, so if they're doing like a massive site of subdivision, like 100 homes, perhaps they need to post like $5 or $10 million of security to a municipality. In that event, a bonding company, unless they're extremely liquid, might require some sort of hard security. So perhaps it's a mortgage on the land itself, or maybe a mortgage on an outside piece of property. We get creative. If you're a REIT or a large developer with a big balance sheet, you can get a facility approved with indemnity only.
So it sounds like this is much better than just doing a regular LC.
Yeah, 100%. Like the thing is, like with conventional financing, there's the LC facility baked into the construction loan. So you don't really think about it, but when the project's done and the asset's complete, the loan's paid out, there's a warranty obligation for the subdivision agreements. So you often, in conventional condo, have to put cash into a bank account at the end of the project, and that kind of sits there for 2 years. With the bonding route, that cash never sits there.
Yeah.
That's good.
No real negatives to it.
No, it's great. It's great for the development community.
Yeah.
It frees up a bunch of money. It's equity that can be used for purpose-built rental in new homes for Canadians.
Construction lien bonds. I don't want to harp on this too much, again, because they're challenging to procure. No one likes them, but they are very useful tools if you have a lien on title. Mid-construction, there's a dispute with the trade. They have lien rights and place a lien on title. Basically, the project is put to an absolute stop and halt, and no funding can go through. The courts require that you post either cash or a construction lien bond in the amount of the lien plus $250,000 or 25%, whichever is the lesser of. The lien bond, similar to what Frankie was alluding to on the development bonds, are typically issued on an indemnity-only basis. So it's much more favorable to post a lien bond than it is cash. That has to sit there potentially for years as you work through this dispute with the trade. Issue being is the surety has to come in and put themselves in the middle of a dispute, which no one likes to do. So these can be a little bit more costly. I'd say 2% is kind of more of a benchmark than the 1.5% on a lot of the other bonding products. But
it's 2% of the disputed amount, or 2% of the whole budget? Like
2% of just the lien bond value.
Bond. So if it's $1 million lien, it's 2% of that. Okay.
Yeah, plus $250,000 or 25%. But they're not the easiest things to procure, but they're very valuable tools. The underwrite, again, it's not too onerous. So Again, I don't want to harp too much on it, but it is a valuable service that we do provide as well. So if this ever does happen, even if we're not on the bonding already or the construction insurance, we're happy to try to place these on a one-off basis.
Does the court need to approve this bond though, it says here, or no?
No.
They do approve the
They'll
bonds.
accept bonds.
Yeah.
They'll accept bonds.
Yeah.
And does this take long to secure one of these?
It probably takes, it can be 2 weeks, 2 to 3 weeks. I mean,
Okay.
it's always a rush when a
Yeah.
lien's on title, so we move very quickly.
I'd say about a week. Like, you can't really have a lien stay on title for over 3 weeks,
No.
right? Because if the funding's happening every
No, it's a
month,
problem. Like,
Yeah.
we've had
Need it off.
situations where
So
we can't
yeah,
advance, right?
like
Yeah.
if someone
So-
comes to us and says we have a lien bond, it's top of list,
Yeah.
right? Like, we gotta
We
get
jump
done
on it
ASAP.
aggressively. Yeah.
Okay, so pivoting to bonding and insurance for condominiums. So standard condominium development across Canada, Ontario specifically, Tarion bonds. So Tarion Warranty Corporation is the administrator of the New Home Warranties Plan Act in Ontario. They provide deposit protection of up to $20,000 a unit, as well as offer warranty protection on new homes. So essentially in Ontario, before a developer can even sign an agreement of purchase and sale with a new purchaser of a condo, they have to provide security to Tarion. So that security is usually in the form of a letter of credit or bond. So Tarion usually requires between $20,000 to $40,000 per unit of security. So if you're building a 100-unit project and they require $20,000 of security per unit, that's $2 million of security you need to post to Tarion. Nobody wants to put $2 million of cash in a bank account and give an LC to Tarion for it to sit there for 7 years, because it sits there for the warranty period as well. So often developers go the bonding route. And with that, there's also excess condominium deposit insurance. So under the Condo Act in Ontario, every time you collect a deposit from a purchaser, it needs to be held in a trust account. You as a developer cannot use those funds unless they are insured under an excess condominium deposit insurance facility. There's a big benefit of using deposits. They're much cheaper than conventional bank financing. Your bank financing is prime based. Deposit insurance is usually around the sub 1% in terms of what we charge to get those deposits. They're usually part of the financing stack for most well-diverse developers. It's equity deposits and then construction loan, as well as commercial, condo, and industrial. If your industrial commercial project is condominiumized, it also falls under the Condo Act. So you have to insure those deposits to use them under a commercial condominium deposit insurance facility. And then lastly, deposit protection is very prevalent in BC and Alberta. Under REDMA, BC requires that all deposits be paid into trust and insured. Same with Alberta under the Real Estate Act.
Mm-hmm. I mean, I'll close out, I guess, the condominium, your Tarion bonding and excess condominium deposit insurance with kind of our value add is I know there's a lot of competitors in this space, but our goal as brokers, and this is the foundation of our practice group, is the deposit insurance solution that we provide. We run our clients through a competitive bid scenario, providing them 4 to 5 term sheets that vary in terms, and it can be lower rates, it can be more access to deposits prior to your construction lender kicking in. That's our job, is to get you the most competitive options.
So we underwrite in-house for this stuff. So we'll collect all the information and we kind of have an understanding of what the best deal would be for you. And then we go to market. So there's 5 markets that do this. They all think differently. So they all look at risk differently, and maybe some offer lower rates or more advantageous deposit release terms. So having 5 pieces of paper for you, showing you what you can get versus one is extremely important for our developer clients. So it's a big value add of what we do here.
Okay, great. So we got about 12, 13 questions. Just give us a minute to pull up the questions that were sent to the chat. Criteria that you're looking for in the GC to be comfortable issuing a bond?
It's like we said when we were going through the general contractors underwriting info on that page. Really, it's financial wherewithal, to be completely frank, but experience and knowledge about that specific region, relationships with those sub trades that they're hiring. That all comes into effect. It's more of a holistic underwrite, but at its core, it's the financial strength of the group.
Okay.
I think that's a good one, the posting a letter of credit. So I think this is alluding to having to post an LC to add on the security for the performance.
So that's not a requirement. That's just saying that's a strategy you may use.
100%.
So there was a question like, an LLC needs to be posted. on a performance bond. It does not need to be posted.
No.
It's in certain circumstances, if a deal doesn't qualify, it's a strategy that you're using to help qualify, right? Just as in terms of a second mortgage or
Exactly.
yeah, some other way, but it's not a requirement.
It's not a requirement, no. And our goal is, again, to take this to market and provide you with multiple options. Some may have an LC component, some may not, and that's part of our goal as brokers, to work with you to find that best strategy.
This question here: bonding required on prefabricated buildings,
Elements.
elements and things like that. We did do some prefab stuff, and CMHC did require bonding on it. But that might be a reflection of price too, right? Would that just be a much lower price potentially?
I think that's more of a case by case basis.
Yeah.
You know, if we haven't actually seen one of that or it come up directly on the deals we've looked at, and I know we've looked at 50 at least. That sounds like it's more of a specific requirement to that project.
Okay, with someone asking here on a third-party GC if they're providing guarantees on the cost overruns, I guess like a fixed price contract I think that bonding still may be required, right?
Yeah.
It's not.
If you're a third-party GC bidding on CMHC builds, you're going to be looking to your broker, and again, we'd be happy to facilitate that conversation. The personal guarantee, it's going to be case by case. When we brought that up, that's more the developer self-performing. If you're a third-party GC who's building a facility in place, it really depends on the underwriter of the finances. If they're not strong enough, these sureties may be looking to take a personal guarantee as well. And again, it's going to be a case-by-case basis, but happy to discuss that further. Feel free to reach out to Frankie or myself directly. What are the costs of bonding for an experienced contractor, percentage of contract? You could see as close to 90 basis points. The experience does come into play in the surety's underwrite, but I would say again, it's the financial strength of the group and how well capitalized you are and the liquidity that you have should there be cost overruns or issues with trades.
Yeah, I'd also say the third-party GC might have their own bonding facility as well.
Yeah.
So they get their own rates. They probably won't pass that along to you, but they will pass along the cost of bonding to you more than likely.
I'll comment on that. At what stage in the project does it make sense to engage with you guys? I like to say about 4 weeks prior to COI issuance or as soon as you get your COI, because that's when you're going to start strategizing on when your first draw is and also if you're going to be needing bonding, and we can get into the weeds on that. But I'd say about 3 to 4 weeks from COI issuance.
Yeah. What volume of transactions do you do in Winnipeg? I don't think we haven't issued any bonds in Winnipeg.
We haven't issued any. I have 2 on my plate right now. So it's starting to pick up more in Winnipeg seemingly, but again, I don't think
It doesn't matter what market.
It doesn't.
It doesn't make a difference.
CMHC is agnostic to
agnostic
requirements.
market,
Yeah.
things like that. We do construction loans there, so that doesn't impact where you are in the country. Pricing doesn't matter as well. Does geography matter in pricing?
No.
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 Environmental issues?
Yeah, I mean, for geography, it's a great question.
Like Western
Geography.
Canada, is it more expensive?
No, I'd say it's the same everywhere. Like where an insurance company might be looking more prudently is if you're building like Muskoka or something where weather might pose a big risk to construction, because often you can't dig into the ground there for half the year. So they'll look really hard at the actual timeline of what you're anticipating for construction to make sure it makes sense.
They'll also they really want to know the relationships with the subs. Have you built in that area? Do you know the guys you're working with out there? I wouldn't say maybe it impacts the cost. It may impact the timeline to get us to an approved kind of terms and condition letter.
Some very interesting questions here, and I encourage people to follow up later on an individual. Some very specific questions here, so we can't get to all of them. Some need a little bit more thought, but obviously it's a hot topic for people, and this is recorded, so we will send it out to everybody afterwards if they want as well. City of Vancouver here. Are you familiar with the question here? About the City of Vancouver?
They're exploring surety bonds. Yeah, so the City of Vancouver is currently looking at the acceptance of those development bonds. We'll know more when they make their formal announcement. But yeah, I'd say overall, like if you have any questions on anything you saw today, reach out to Brendan or I. If you have any ideas of something that might require bonding or involves insurance for your development, we can probably find a solution for you, or perhaps it exists in the marketplace. So don't hesitate to reach out.
Someone asked a further question here, I don't know, but like on deferring development charges, creating a bond for that. I don't know the answer to that.
I mean, we've run into, I don't know about that specifically. Again, Frankie and I love to, if there's a challenge, we love to try to get creative and find a solution. I'm not gonna, hold myself to this, but we are working on the rental achievement holdback and posting a bond in lieu of that holdback where it's very early stages. But if there's a creative solution that you think would help you, please reach out and we'd be happy to have that discussion with you.
Yeah, that's certainly a hot topic today as well.
Yeah.
Okay, so I think we covered all the questions. There were some others that overlapped, but I guess that's it, right? So anything else, you can follow up with us individually. Thanks everyone for attending. We'll email it out, and thanks for joining.
Thanks so much.
Thank you.